Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me today, as always, Michael Becker.
Hey, Paul.
So we are going to be listening to a replay of a podcast that Mike did, probably about a week or two ago. I thought there was some great information in there. Mike shares a little bit more about what's made him successful in operating multifamily properties. The podcast is Jacob Ayers. And so Jacob does a podcast called The Real Estate Way to Wealth and Freedom. And Mike, give us a little background before we get going.
Yeah, I thought it turned out pretty good. He just asked me a bunch of questions, kind of how I got started into multifamily, and then some of the basic principles that I think successful apartment owners and operators and syndicators live by. So I thought it turned out pretty good, and I appreciate everyone listening to it. Paul, what do we have coming up?
So on June the 7th, we have Amy Morgan, who is the Director of Valuation. That's the appraisal department for CBRE. Is going to be talking with us at the Old Capital Speaker Series on June the 7th. It starts about 6:30 or so in the Grapevine Convention Center. So if you are in the area and you want to kind of figure out how to bring additional value in this hot market, you want to listen to Amy Morgan and her group, because they do probably more appraisals than any other group nationwide on apartments. And she has some great information. We bring her in once a year, and that usually is a huge crowd. So make sure that you go on to the Old Capital podcast and sign up for that. Anything additional, Mike?
That's it. If anyone's interested in getting more information about apartment financing, you certainly go to oldcapitalpodcast.com, where you can sign up for Amy Morgan's speech on June 7th. You can also download the Old Capital white paper on multifamily financing 101, as well as the sample due diligence checklist.
Sounds great. Listen away. Thank you.
Hi, and welcome to the Real Estate Way to Wealth and Freedom podcast. I'm your host, Jacob Ayers. Today, I want to welcome you as we have the privilege of speaking with Michael Becker. Michael is a 15-year veteran commercial real estate banker and has originated and managed numerous portfolios of permanent and bridge loans in all major asset classes. Over the last 5 years of his banking tenure, Michael focused exclusively on multifamily properties. As a portfolio manager, Michael directly oversaw the management and financial performance of the countless C and B class multifamily properties he originated loans for. As a result, Michael has developed a keen sense of the multifamily arena and has since started building his own portfolio of multifamily properties. Michael brings a unique perspective and fundamental understanding of the banking side of the business, and today I'm excited to welcome Michael onto the show. Michael, how are you?
Hey, thanks for having me on, Jacob.
Absolutely. So, Michael, can you tell us a little bit about yourself and your background?
Like you mentioned, my background is I was out of the banking industry and kind of started out of college as a bank teller and just kind of worked my way up. Grew up in suburban Dallas, where I still live today, and I just really, after college, got into banking kind of pre-recession, and the world was on fire and you couldn't make a bad loan. And then one day that all kind of changed, and bankers go from being a respected profession to a hated profession seemingly overnight. Didn't have any idea what I did to cause it, but it's kind of how it was. And so I had a couple tough years in the banking industry in 2008, 9, 10, and then kind of coming out of the back end of it, I was always an income real estate lender. So I just loaned on income producing real estate, being whether that was apartments, office, retail, industrial. But what I kind of focused on coming out of the recession, because the only thing that was working was multifamily. So really kind of coming out of that, I started doing it. And then one day I had a really, really bad day one day, and it was in April 2011. And I was right around the time I filed my tax returns, and I couldn't even itemize. I was, making a good living as a banker, and I realized I was paying so much in taxes. And my CPA one day told me that he couldn't help me because I didn't either own a business or own any real estate. So I went out and started making some changes and doing something about it. And like most people, I started about 6 years ago with 1 3-bedroom, 2-bath house. I ended up doing 16 rentals, and then I transitioned over into to apartments. And over the last less than 4 years, We've done actually about 4,300 units, and we sold about 1,000. So we currently own about 3,300 units in the Dallas-Fort Worth area. So that's kind of the nutshell of what I've done over the last 6 years.
Yeah, that's great. So you've kind of come into real estate investing from the banking side and had a really good foundation and knowledge base on that side of things. So you came in well equipped and well prepared, it sounds like, and have experienced a lot of success since then. So you said you got started out in single-family houses and built up a portfolio of about 16 of those. Could you talk a little bit about your transition from single-family houses into the multifamily space, since you had so much experience with that side of things already?
Yeah, so in retrospect, I would have skipped the single-family houses. I did not need that. I had a little bit of money. But, it was a good way at that moment in my life. We were just I was still the wounds were fresh of the recession of being a banker doing problem loan workout. I noticed in several instances, a lot of the issues people had were in partnerships. And so I didn't want a partnership at that time. So I knew I had a little bit of money. I'd go out and put, $15,000, $20,000 on a $100,000 house in Mesquite, Texas. And we'll rent it out for $1,200 a month, and that would work. And if it didn't work, it wouldn't bankrupt me and my wife. So that was kind of how we did it, and that worked. And then did another. It's kind of snowballed. But what I found was scaling is hard on single-family homes because they're all in different locations. Is the management of it was kind of eating me up, and I had a full-time job, a wife, and 2 kids on top of it all. So it was just kind of a very laborious thing. And then in Texas, it gets hot in the summer, obviously. And then come July, I got my 3rd or 4th HVAC is out call from whatever house, and I just kind of get frustrated. And at the bank every day, all day, my job was just to underwrite and originate apartment loans, and that's what I did. And kind of watching all these guys that I'm making loans to, and I was really just kind of being observant to it that I knew as much or more about this than they did, but they were the ones going out and getting rich, and I was getting a nice paycheck. So that's really kind of motivated me. And I'll give you one example, and I have dozens and dozens of examples, but this one day, 2 guys were buying a 30, 40 unit apartment complex, something like that, about $1 million deal, give or take. And one of the 2 guys was literally a bus driver. And, literally a bus driver. And I'm look at this guy. It's this bus driver's buying an apartment complex, and I'm giving him $1 million to do it. And I'm if this bus driver can do it, what am I doing?
Yeah, something's wrong with that picture.
That's right. Yeah. So I got really motivated, and I'm a guy that gets excited and focus. I can focus and go achieve some goals. And then I met my now business partner, a guy named Sean, who was living in Los Angeles, working for a broker in Beverly Hills, is helping high net worth people buy apartments in Texas. And I made a loan to one of their clients. So they needed some help at the time with what they call asset management, someone to put a little money in the deals, kind of run the deals, and they brought all the capital. So I leveraged that. I saw that opportunity, and I leveraged his capital source and our collective knowledge base. And we ended up doing 4 deals in 6 months, about 800 units, kind of out of the gate while I still worked at Wells Fargo. And that was kind of really what I did to really kind of set me up to get the confidence to go at this thing full time. And that was, we closed on our first deal. It was November 13 when we closed on it. So about 3.5 years ago, a little bit over 3.5 years ago, we closed on that deal. It's been a pretty rapid rise. I take a look back on it and how quick we've gone. It's just amazing how it feels like it's been 10 minutes in the grand scheme of things.
Yeah, that's very fast success, and you guys have grown very quickly, but I think that's all due to your background in real estate, and you have a good understanding of the way of commercial lending, so I think that probably helps you out, if I'm not mistaken.
Oh, yeah, definitely. I was ready to roll, But and the thing, Jacob, everyone starts with what they have and where they are in their life. So I hate to come across braggadocious or anything, or it comes across as I can't do that. I didn't have this background. But everyone starts with what they have. I had a little bit of money. I had that I saved over the years, and I accumulated some capital by doing these little houses, at a good time, and kind of snowballed. And that's essentially what we've done. But, you got to have a little bit of money to get in this business to be really successful. The guys that don't have money, it's just really hard. So if you don't have $100,000 or so laying around, you need to go accumulate some capital. So whether that is, saving your money on a monthly basis, and or doing some little houses or some flips, and then live below your means, delay gratification, save some capital. And that's kind of what you need to do. So if you can do that, if you have a little bit of money to get in this business, then the next thing you got to do is, what trips people up is, going from 0 to 1, right? I don't have anything and I want to do my first deal. The first deal is so hard. And you have all these unknowns because you just haven't done it. And then going from your first to your second deal is exponentially easier. It's not like a little bit easier. It's 10, 12, 20 times easier than the first deal because you understand it, you've done it. And that's what I always try to get across to everybody that, 0 to 1 is hard, and then 1 to 2, and then you can just hit the repeat button after that. It gets exponentially easier.
Right. Yeah. And
as you go forward.
Yeah, absolutely. And that's kind of the power you've talked about in multifamily investing with, the power of scaling.
That's right. So, some of the things, I guess, if you're an aspiring apartment owner that you need to do, first and foremost, you got to just realize this is a completely unfair business and life's unfair and you've got to get over it, right? People that have money, people that have relationships and contacts and experience are going to get the deal over you virtually every time. So what you got to do is really just kind of get yourself positioned to overcome some of these weaknesses in your profile. So first and foremost, it really starts with team. So you got to get team members that can then kind of overcome that. So that could be various forms. So, on your team, you need to have a good property manager, a good third-party professional property management company. So when you're starting out, it's one thing to manage a little house. It's a completely different thing to manage an apartment complex. So I would really dissuade anyone that's trying to do anything of size to self-manage. And your lender probably won't let you self-manage a deal anyways because you don't have any experience. So if you get a good professional third-party management company in that area that focuses on that quality of asset, C-class or B-class or whatever you're looking to buy. Most people start in the C-class space. That's a good place to start. And then the other people on your team, you need to obviously get a good lawyer and a really good mortgage brokerage company. So, I'm affiliated with Old Capital Lending still, and that's where we have the Old Capital Real Estate Investing podcast, and we do about $500 million in lending a year, and 95% of it is on multifamily. So we help our clients all the time in our marketplaces that we serve in Texas, primarily. We do some stuff across the nation, but primarily in Texas. These brokers, we know all the brokers in town. So the brokers will call, they drop that Old Capital, my partner Paul, or one of the other guys work with them. They'll call us and we can kind of vouch for our clients a little bit that they have the capacity to get a loan and close the deal. And then your management company, the management companies that are well known in the area, all the brokers will know those guys as well. So just really kind of getting that transfer of credibility. And if you really want to get going, if you can find someone that has some multifamily ownership experience in the areas you want to do and convince them to partner with you on a deal, that's a good way to get going, get their experience. And then when you go in and talking to the brokers and the owners, you can say, we own, 1,000 units instead of I don't own anything.
Right.
We own this.
Right.
So the power of team.
Yeah, absolutely. I think team is a very important thing, and maybe the most important factor in getting your real estate investing career started is surrounding yourself with the right people and bringing on the right partners, and just building your team from the ground up can really trajectory your success in a different way.
Yeah, getting educated. Certainly if you can find a partner that has some experience, you can have kind of like an informal mentorship that way, or you just go find a formal mentor that's done what you wanted to do, and you have a program out there, and there's multiple programs like that out there. And at least there's a couple in Dallas that I know of. And you join a program, and then within that program, then you also have people that are also in the program that have some money and are interested in multifamily, and then you can start doing deals together. And that's a good way to get networked and meet people is within groups like that. So that would be the quickest way to shortcut it, is to join a reputable multifamily mentoring program. And there's multiple in the country, and then that's a good way to get going.
Yeah, absolutely. So when we're talking about bringing on partners, could you talk a little bit about what changed in your mindset when you were transitioning from single family homes, wanting to avoid a partner at the time, to moving into multifamily space and bringing on that partner?
Yeah. So like I mentioned, every time I bought a house, I bought myself like a little job. My goal when I started was to do 20 houses, make $500 a house a month, $10,000 a month. That's kind of what my goal was. And every time I bought a house, I felt like I was 5% closer to achieving my goal. But then I bought, 5% more headaches and so forth and so on. And then, like I said, I was self-managing these deals. And then whenever I got that, whatever call it was, I can't remember exactly what the catalyst was that day, but it was something, either HVAC or garage door broke, something like that. I was just like, I'm sick of this. I need to scale. And then, I kept looking at my life and seeing these bus drivers get $1 million loans, and I'm the one giving it to them. So that's really, really what it was that I decided. I was like, I had to get over that self-limiting belief that, partnerships are bad. Because if you set it up properly and you have the proper expectations going in and everyone's transparent with each other, partnerships are very powerful. So my partner and I have one primary business partner that we operate these deals with, and now we have employees underneath us. And then we do deal-specific raises where I go syndicate money and then have a bunch of limited partners that are just kind of essentially capital partners. So I got a lot of partners, essentially. But my primary partner and I have very complementary skill sets. So he's extremely analytical. He does a spreadsheet. He's almost like a savant when it comes to stuff like that. But he's not the best when it comes to implementing renovations and or potentially even raising capital in front of a large group. And that's kind of what I do a little bit better. So like I mentioned, this business gets exponentially easier the more that you do. I think a good partnership, if you have a really good effective partner, you don't do twice the work that you do on your own. It's multiple times more efficient because he's really good at what he does and he excels at it. And then, I could do what he does. I just won't be as good or efficient at it. And then that would detract me from doing things that I do well. So if we kind of focus on our strengths, so we can do exponentially more than if we just did it on our own. So that's really one of the things that partnerships really help. And then once you have that, then you can then start scaling the company. And the scale has been, for me, the last several years, kind of the interesting part, because you're not born knowing how to run a company that has, $400 million in assets in it, or whatever our company has right now. That's something that you gotta kind of just figure it out as you go. And there's certainly no textbook that tells you how to do that. Right. So it's been kind of fun and interesting.
Yeah. So I always talk about the power of leverage, and that not only means capital for investments, but other people's times, resources, their strengths. So what you're talking about with your partner, and he's got his strengths, and he's got his background, as do you. You guys are really, you've got a symbiotic relationship there where, you're playing off of each other and, helping each other build and grow and, develop a better team. So I think that's really important.
Yeah. So if you really think about it, I like to always say these deals, like what I do for a living, essentially I'm an apartment syndicator, and what I do for a living is a really good business. And if you think about it, what I do for a living is I would go buy an apartment complex. The bank gives us, say, 75% of the money. With a loan, I get 25% primarily through the vast majority of that is from other people that I raise capital from. We always put a little money in, but basically, bank gives me 75. My investors give me 25. I hire a professional management company that does 95% of the work, all the day-to-day, running it, making sure they lease units and fix it up. My tenants pay our debt back plus some positive cash flow, and then I don't pay any tax through depreciation. So that's essentially what my business model is. And so if you could just figure that out, a lot of people make this stuff really complicated, but at its core, I basically, the bank gives me money, my investors give me the equity, my management company runs it for us, my tenants pay our debt back plus positive cash flow, and you don't pay any tax. That's essentially what the business model is, and it's pretty great, to be honest with you.
Yeah, absolutely. It's a powerful formula for wealth creation.
Yes, it is.
Could you talk a little bit about the side of raising money and what it looks like when you're pitching these deals to investors and what money you're having to come up with?
Yeah, there's a couple sides of the transaction. So there's the front end of the deal. So when you get into these deals, it's not like a house, and that's one of the things I think that trips some people up when you're starting. So when you buy a house, you put down $500 or $1,000 in earnest money, whatever it is. When you buy a small apartment complex, you buy, say, a $1 million or $2 million apartment complex, you're putting up $50,000 in earnest money, or $25,000. If you buy a $34 million one like the one we're about to buy, we're putting up $500,000 in earnest money. So as a sponsor, you got to front that capital. So if you don't have that that's why I say you got to have a little bit of money to get started in this deal. Because if nothing else, you got to front the pursuit costs of this deal, and or find a strategic partner that's willing to front that pursuit cost for you, or you can't get past go right. Yeah, that's what you need to start these deals.
Right.
That's number one. And then once you get it tied up, then like how the heck am I going to get the rest of that 25% that I need to put in the deal? So then it's just about being networked and doing it in a compliant fashion. And then your first deal is hard because you don't have any experience and people don't want to trust you with their money because you've never done it before. So that's always kind of like the catch-22 people get tripped up on. And I'll go back to what I said before. It's about team. So if you have an experienced partner on the team that done multiple deals, you can just use the power of we did this, we did that, we own this, and it's true. It's you and your partner have done that. And you've done nothing, and he's done it all, or she's done it all, or whatever. But it's true, and they're on the team. So if you don't have that, then the next best thing is, well, my management company manages all these assets in this location, et cetera, et cetera, et cetera. So those are the things that you need to kind of reference. You need to identify the weaknesses and then present the mitigant to that weakness when you're raising capital. And that's really kind of how you get through it. And then you just essentially, when you're raising money, what people want to know is how they're going to get their money back. That's where you should always start with, like, how I give you $100,000, when am I going to get it back? And then what do I get along the way? And then you just need to go through the plan of how you're going to, why you like that asset, the location, is it underperforming? Do you have the property down the street's getting $100 more in rent than this one? They're very similar locations in age of construction, but that one has updated flooring and appliances, and mine does not. So if I just do $3,000 in upgrades to my unit, I get $100 more in rent. Simple little things like that are good, and simple is better. So people try to make stuff complex, but in most things in life, you just keep it very simple. That's more effective when you're raising capital. So that'd be a tip. I would say keep it simple, and then just be effective in the way you network and market and with people. So if you go to local real estate investing clubs, you're going to meet people that are interested in real estate investing. If you try to go to your coworker at your straight job and your corporate job in the cubicle, one, they may or may not have money. And then two, then you got to convince them about the why real estate, why this deal. Well, if you go to a place where they're already interested in it, they're just going to convince them about why this deal.
Right. That's a really good point.
So effective networking is better. I mean, you got to network, you got to get out. I like to say that no one's going to come to my office and hand me money or a deal. I got to go out and get it. So I'm constantly going to events, and I just went to the Real Estate Guys radio. I'm sure most people have listened to if you listen to this, you probably listen to the Real Estate Guys radio show. And I was having their 15th annual Summit at Sea. So I was hanging out with guys like Tom Hopkins and Robert Kiyosaki and, Ken McElroy, who's like now my friend, right, by going to these events. And I meet with them. And if you go to that event and you spend $7,000, $8,000, you're generally going to be a rich guy, or you don't go do that, right? So then you go that's an effective place to go network and meet people. And I do that on a regular basis in different ways.
Absolutely. That's great. So, Michael, could you talk a little bit about your current deals, how you structure them, and what those deals are looking like right now?
So when we started, first deal I did was a 120-unit property in Garland, Texas. It's built in, I think, 1974 or 5, something like that. It had a flat roofs, individual HVACs, had older deals have cast iron sewers. So like cast iron sewers versus the new ones have plastic or PVC and an asphalt parking lot. So what I don't like about it was a great deal. We made a bunch of money. We doubled the money in 2 years and got out and 1031 and something nicer and better. But what I look for now is we kind of got, that was definitely C quality asset and C plus B minus location. Nothing wrong with that, but it was just kind of what it is. And what we do now, I think we paid about $4 million. And then the last deal I closed on was a 2004 vintage deal, 260 something units. And that was kind of like an A minus deal. So kind of what I look for now is kind of B to A minus is kind of where we're looking for. What I like about that is one, they're bigger, generally speaking, in unit count, as well as they produce a little bit more revenue. So you get, you're able to afford better quality staff on the property as well as more staff on the property. So the bigger they are, the easier they are to operate. And then you have things like concrete parking lot, PVC sewers, copper wiring instead of aluminum wiring, pitch roofs. The buildings are just better. You have hardy siding instead of the old wood. So you just get better physical construction quality on the little newer assets. And then our ability to attract capital and do bigger deals is greater the more that you do, because once you have a track record, it becomes easier and easier. And it's like I said, it's an exponential business, not a linear business. And so that's what we focus on: bigger, better, newer. So we essentially we have the last old deal or two deals. So one, we just got agreed to, should be in escrow today actually, to sell it, which is it has aluminum wiring, flat roofs, older deal. So we're going to sell that deal, and then we're going to 1031 into a 2008 vintage deal in North Fort Worth. So I'm going to go from like 1970 to 2008 vintage with the profit we made off the older deal. And that's the deal we want to hold. What I've observed, a lot of people don't really grasp this concept that the basics of the apartment investing is you have your income, you have your operating expenses, and then you have your net operating income or NOI. And below NOI line is like your capital project. So if you go in and change the roofs out, that's not a recurring expense. Or you resurface your parking lot, that's not a recurring expense, one-time expense. So it's below the line. But what happens with these older deals is you have all these non-recurring expenses that recur all the time. You know, you have your sewer system goes out and you spend $10,000 fixing a collapsed sewer line. That is below the NOI line, but it's an actual cash expense. So, you know, these people own older deals have a lot of these non-recurring expenses that recur all the time that are actual cash expenses. So you don't have as much of that on the newer deals. So why it might look a little more attractive from a cap rate perspective and cash flow. And there's nothing wrong with C-class properties. That's where I started. I would still buy a good C-class deal if it came across my desk today. But if you want to own it for the long term, those are harder assets to own for the long term. Another thing I've seen a lot of people do, especially as a banker, you see people come in, they want to go buy a 30-unit deal, and then they think they're going to own this 30-unit deal forever. My experience, you own apartments in dog years, right? Every year feels like 7.
Right.
So, you know, so when you buy this little 30-unit deal, it's great, and that's a great starter property, but these people try to come in and put like 10-year fixed rate debt on these little 30-unit deals with large prepayment penalties. And then one or two things are going to happen when you do your first deal. Either you're going to get in this deal and you're going to be like, man, I love this business. I really want to do it. Man, I want to sell my 30-unit deal and go buy a bigger deal because, you know, it's hard to manage a 30-unit deal. I want to buy a bigger, better, nicer one. Or you're going to get in it like, man, this sucks. I hate it. I want to sell my deal and never do another deal again. But, you know, these people come in and try to put these long-term fixed-rate deals with large prepayment penalties. And these loans are assumable, and that's what I do on my larger apartment complexes. But you got to qualify to assume it, so they don't want to have a first-timer get a long-term fixed-rate loan. So you really kind of shoot yourself in the foot by the type of debt they put on it. So just know when you get in your first deal, it's great. You got to start a property, and then you're going to either love it or hate it. You're going to want to scale up or get out. So these deals, you don't own them forever, at least when you're starting out, even though you think you might want to when you get in the business. My experience, most people, like I said, go up or go away.
Right. So when you're looking at these Class B plus A minus properties, are you still trying to identify value add deals, or are you looking at already stabilized properties?
Yeah, so what we've always done is kind of like light value add with the stabilized deals with a light value add. So that's what I still look for. We are finding deals. I mean, there's different degrees of the value add. So the deal that we're looking at right now that we got agreed to buy, basically they just did cheap interior finish outs in the bathrooms and the kitchens and things like that. So this is going to be kind of like we still have 9-foot smooth ceilings instead of 8-foot popcorn ceilings. We still have fire sprinklers. We got a nice exterior, but the inside's just kind of cheap. So we're going to go in and do a better backsplash and make the bathrooms a little nicer and frame the mirror and do light fixtures. And that's really kind of what we're doing. So the degree of the value adds a lot lighter on this deal. So that's kind of what we look for. But then we bought a Class B deal last year that we had to completely reside and repaint and redo all the balconies and spend, $1.8 million on renovations on a 334 unit deal. So that's a bigger renovation job. So the degree of the value add is a little bit less. The other thing I'm noticing, because we're sitting here in the middle of April 2017, we're probably 7 years into the cycle. We're still buying deals. So I'm going to still continue to buy deals through the cycle. And there's always a deal to be have that's relative value to current market. So we're still going to continue to buy deals. But what I'm observing as we sit today, everyone wants this value add story. Everyone's value add. And that's what I want, right? That's what everyone wants.
Right.
And everyone buys a story. So if you can come in, do the unit upgrades, raise rents $100, that's a good story to have. But what is happening in the marketplace, the value adds are so hot that everyone's chasing them. The cap rates are getting compressed. The cap rates are going lower. So meaning you're paying more money for the same income stream. Right. On these value add deals. So anymore, you're overpaying for these deals. And the problem is you're having to overpay so much for the deal that, just to get the upside, that you're taking all the risk on the back end. The seller of this property is getting paid half of that upside just by having the value add, in place. So anymore, we're looking at deals that are closer to complete, that have lighter value add, because you're getting a better cap rate relative to the true value add deals out there. And that's kind of where my mentality, this is a fluid business with a lot of nuances to it. And that's the nuance and the fluidity in the marketplace. So we're kind of the longer we're in the cycle, the less attractive the value add is becoming, because you're having to pay so much more for that upside that is taking all the risk without as much return as you can get 3-4 years ago. So that's kind of what we're focusing on, right or wrong. And then, but the one thing we're not bending on is like location. So, the longer we get in the cycle, the more location specific I get. I like to have all these little sayings and analogies and stuff. One of the things I like to say when you're starting in this business, if you could do 4 things in this business, your success rate is probably 95% or greater. So if you just do 4 things, so the first thing you need to do is not buy properties in the hood. So just buy in nice areas, low crime areas. It doesn't have to be the best part of town, but like a older part of town that's low crime, that has employment near it and good highway system not too far away. That's what you should do. But crime, okay. The hood is hard, right? 2, you need to make sure you come in this deal well capitalized. So you make sure you do a good physical inspection on the front end, identify any deferred maintenance on the property, and then put that capital in on the front end of the deal. Your banker is going to likely give you 75 to 80% of that dollars with their loan as well. So do it on the front end. Doing it out of cash flow doesn't work. So what happens is, if you're, say, in Texas, like I live, it gets hot in the summer, you have an occupied unit and your AC condenser on the outside goes out, and you don't have the $1,000 to replace it. So you go to a vacant unit, you take that condenser, you put it on your occupied unit, and then now you created a down unit because you have a unit without an HVAC condenser, and then it snowballs and it snowballs and it snowballs. That's what I saw happen that tripped a lot of guys up. So that's number 2. Make sure your CapEx is in the front end of the deal and you do good physical inspection. 3, you make sure you have good property management. So people that try to self-manage get themselves in trouble. So I've seen cases of like a UPS driver in California buy a property in Texas, and then, he just runs in the ground because he's a freaking UPS driver from California and he's 1,500 miles away. So if you have a good third-party management company that specializes in that quality of asset in that submarket, that part of the town, that's a good way to do. And then finally, what I saw a lot of people get tripped up are having a maturity at a bad time. So like I mentioned, have these smaller deals is kind of hard to put long-term fixed rate on because they have a large prepayment penalty. But what we're doing is we're taking 10 and 12-year money out with Fannie Mae loans, and the Fannie Mae loans can be assumable, and they allow what they call supplemental loans. So what that means is I can sell a loan to you, you come in and take over my mortgage, and a supplemental loan will allow them to give a second lien cash out note to me and or re-leverage a loan back up to, say, 75%. So give it a second loan, so it's like a 75% total loan to value. So it's pretty powerful that, I can go and sell it, you can assume it, and get a second loan to 75%. So it's pretty close to market terms. But, we have an exit strategy of 3 to 5 years. But if the economy's in the tank in 3 to 5 years and I have a 10-year loan, all I got to do is kind of hunker down, ride it out and come out the back end. But if I had a loan maturity, say like in 2009, when the capital markets are frozen, my value is down, temporarily the value is compressed. And if I did an 80% loan at the time, I lose 10% of my value and now only have a 90% value to the outstanding loan balance. The banker is going to ask me to remargin my loan, so bring some money, pay the mortgage down to renew me. And all my investors are going to look at me like, hey, you just lost 10% of the value of the deal. I don't want to give you more money.
Right.
And then, you're kind of like catch-22. So if possible, and it fits, take a longer term loan out. And you can always kind of ride out the recession. Maybe you don't return as much capital, but you keep your property, keep your skin, so long as you have a good quality asset, you fix all the CapEx on the front end, you have good management, you're not in the hood. You do those things, it's 95% of the success in this business.
Yeah, that's great. Those are all 4 very good points. And I'm like you, I like sayings and bulleted lists and points and analogies. So, those will stick with you, and I think they're all very valid points. So great.
Well, thank you.
So, Michael, you're you've got your successful investments going on. Everything is going smooth. You're growing exponentially. What does the future look like for your investment?
Yeah, so we're last year and we're finishing it off this year. What our strategic plan was is take older, smaller deals, sell them, and buy newer, bigger, better located deals. And that's kind of essentially, we have 2 more to get through. One of them we just got to escrow to sell, and then we have 1 more we'll come out this summer with. We're going to sell those deals, and then we're going to get bigger, better, nicer ones. And we're still going to do deals. We're going to be more location specific, and we're going to continue to do deals, and we're trying to focus on, from the mid 1980s to the mid 2000s. And that's kind of that 20-year range of what we're going to be looking for vintage of properties. And then we're going to put long-term debt on them, and then we're going to, just buy deals that we can force through our efforts a little bit of value add too. So we're just going to continue to do deals and just kind of keep going and make sure we manage them and return capital to our investors. And at some point, we'll have a soft patch in the economy, and hopefully those basic business principles that I put out to you hold true. And whatever the next recession is, if not, it'll be interesting. And we'll figure it out, and that's kind of what we're doing. We're going to keep going forward, and I think it's a great business to be in. And if anyone's aspiring to do this, I think it's certainly great. You just got to make sure you get yourself educated, and work hard and be diligent and be a good person. That's another thing that trip people up. If people do business, people they know, like, and trust. If people don't like you, they're not going to do business with you. So if you're a jerk to people, then you're not going to get deals or capital. So little simple things is what I like about this business is extremely, extremely simple, right? It's not always easy, but it's a very simple business. You just buy something that's nice, fix it up in a good location, you rent it out for positive cash flow, and everything else is kind of noise. The details are important, but it's just a really simple business at its core. And it's really easy to explain to people. And people I think everyone understands apartments. All your potential investors understand it, even if they don't know all the nuances of it. Everyone knows what an apartment complex is and understand that people have to live somewhere, and it's a universal need. So those are kind of wrapping up my words of wisdom, that you do those four things, you keep it simple, you start, and then kind of just methodically grow your way up. It's like my final analogy I'll leave you with is like climbing a ladder. You got to do it like one rung at a time. You can't skip a rung of the ladder or you're going to fall down. You can compress your timelines and climb that ladder faster, but you got to do the one rung at a time. And if you do the right things and you keep pushing forward, next thing you know, you're at the top, right? That's kind of where we've gone in a relatively short period of time. But, I had what I had. I had all these resources and knowledge. A lot of people don't. But that's just an excuse for the next person. They got to go get themselves educated and knowledgeable, and then consistently push forward and take steps along the way, climb that rung at a time. And next thing you know, you're gonna look down, and you've gone a long way.
Yeah, absolutely. Well, Michael, you certainly have a unique perspective on breaking things down into small steps and simple formulas, and just making things very, very easy to understand, and just small actionable steps going forward. So that's great, and I think it provides valuable feedback for our listeners. So yeah.
So the last thing I guess would be if you guys are an apartment nerd, an aspiring apartment nerd, we have the Old Capital Real Estate Investing Podcast. You can find it on iTunes and Stitcher, and we interview a lot of people, and that Old Capital makes loans to our commercial mortgage brokerage based in Dallas. And I don't do that much lending anymore, but my partner Paul and the other guys do a whole bunch of it. And we interview a lot of like first timer clients of us about their first or second deal, as well as guys that own 10,000 units and a lot of the service providers. So I think this really is not a lighthearted podcast. It's really just about apartment investing and all the things that go around it. So, but if that's of interest to you, I think that's a good resource. So we'd certainly love people to go subscribe and listen to it.
Absolutely. Well, the link will be in the show notes. So, Michael, one last thing. At the end of the day, you're experiencing successful real estate investments. What are your reasons why? That is, why are you doing what you're doing? What drives you? What motivates you?
Lots of things, but really, I'm relatively competitive. And I just, I really just had this burning desire. I was 35 years old when I left Wells Fargo. My last straight job was at Wells Fargo. So when I was 35 years old and I was really successful, I led the nation for my business unit in a row on loan production. And so, I kept getting offers to get promoted up. And, I kept looking at my boss's boss. And I was like, I don't want to do what they do. It just seems horrible. And so I felt this fork in the road, there's metaphorically, but it was like, I literally felt this, like if I stayed, any longer, I was going to be 36, 37, 38, 40, 50. I'm going to be my boss's boss, and I was just not going to be very exciting life for me. Or I could go out and take a chance and start my own company. And that's what I felt. It was like this fork in the road at 35, and I was like, I got to get out now. Looking back on it, like it was the best decision I ever made. I bet on myself, and we've been successful along the way, and we work hard. So feel good business, I guess there's one last analogy. It's like a feel good business, right? What I get to do is I get to take a somewhat broken property, fix it, improve the lives for thousands of people that live on my properties are better off because we bought it, fixed up all these little issues that the previous owners were not doing, makes these properties safer, nicer, better. So their families can, live there and have a good life, as well as I get to raise money from other people and return capital to them and help improve other people's financial security along the way. So it's a really good, and then as a byproduct, you can make millions of dollars being an apartment syndicator, and so that's kind of the byproduct of doing good. So that's what kind of motivates me. The more deals we do, the better we make these properties, the better we make the communities, the more lives we change on the properties, the more of my investors I can return capital to and give them a rate of return that they wouldn't necessarily get, say, in the stock market with a safe, secure asset like an apartment complex. And I get to enjoy a great life and go travel with my family and put my kids in the better schools and things like that. So that's what drives me, I guess. Really that and competition. I like to win. So those are things that drive me.
Right. Great. I think having a strong reason why is one of the most important things in your success. So that's great that you've got those and those aspirations, and you're well on track to achieve great success, I'm sure. So, all right, Michael. So where can our guests connect with you aside for your podcast?
Yeah, so that's certainly obviously the Old Capital Real Estate Investing Podcast, or you go to our company's website is spiadvisory.com. That is SPI like spy, spiadvisory.com. My contact information is on there. That's just how that's the business that we operate our multifamilies under as well. So my contact, our bio, all that stuff's on there as well.
All right, great. Thank you, Michael. Thank you for being on the show today.
Thanks, Jacob.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.